Hi, everyone, and welcome. Thank you for joining us today. My name is Igor Zuckerman. I'm a CEO and Chief Investment Officer of Eureka Wealth Solutions, which is um, a boutique wealth management company based in New York, and we specialize in impact investing. And the topic of discussion today is crowdfunding and impact investing. So we have quite a full agenda today, as you can see. We'll start with a little bit of housekeeping. Then we'll start with alternative investments. We'll talk about the legal portions of alternative investments and crowdfunding, about accreditation specifically and various types of registrations. We'll dive into venture angel investing and crowdfunding. We'll look at some crowdfunding assets and marketplaces. And then we'll talk about the different types of due diligence you need, the information sources for it. And then also we'll get finally to impact investing and where the intersection is between impact investing and crowdfunding. We'll do 4 quick case studies, and even talk about some investments that are made possible by crowdfunding. And then we'll finally talk about how you can practically do this if you're interested, or if you have clients, how you can help them do it. So before we get started on the housekeeping, first of all, I'm afraid I have to do a legal or compliance disclaimer. What we're about to talk about today is not is just a presentation for informational purposes only. There is no specialized or personalized investment, tax, or legal advice here. We're also not trying to sell any specific products or services. There's a risk involved in any investment, but especially in alternative investments, and I will be talking about it in a little bit more. And the full disclaimer is found at the last page, but just everybody should be aware of everything I just said. Also, we have an hour allocated. I'm hoping we're going to fit into that. I'm going to try to leave the last 5 to 10 minutes for Q&A. If you have questions as we go through this, please feel free to type in your question into Q&A box. If I see it during the time I'm covering a specific subject, I may be able to answer it right there and then, but as a rule of thumb, I will probably wait until the end. And like I said, this is being recorded, so recording will be available. And if you're looking for slides specifically, feel free to email me, and I'm happy to share them as well. The slides, some of the slides will have some links, so they may be extra useful. And so without further ado, let me first of all run a quick background poll. I always like to know what my audience is. So it's a simple question. Are you an investor? And if so, are you new to crowdfunding, or have you invested in startups before? Are you a financial professional? And if so, are you just learning about crowdfunding, or are you familiar with it? And that's basically for us to get started. So as we answering this, before we start with crowdfunding, we need to talk about alternatives in general. I come from a math and technology background, so for me, everything starts with a definition and then follows with numbers. That's how I make sense of things. So we're going to start with definition. There are a number of different definitions of alternatives, but probably the most practical one and the easiest one to understand and follow is that an alternative is an investment made into an asset class that's different than a traditional, and traditional would be stocks and bonds. This may not be a precise definition, but it actually works in most cases. So certain things like real estate, for example, or commodities. Some of them may be publicly traded, but they would still fall under the alternatives. But by and large, alternatives would be private investments. So before we go that, let me just close the poll. So it looks like most attendees are financial professionals, and they're here to learn about crowdfunding. That's great. That helps me. So let's continue then. So if we're talking about alternative funds, so investment funds that actually focus on alternative assets, they typically would charge higher fees and would typically require significant investment minimums. And for most financial professionals, that's hopefully nothing new. And I apologize in advance if I tell you something you already know. And obviously, alternatives may not always be suitable for all investors. And historically, only the so-called accredited investors were able to invest into those. We'll talk about accreditation in a second. However, some of the benefits that can be derived from alternatives include low correlation to traditional markets, typically lower volatility, and may also offer higher average long-term returns. I will actually show a chart in a second in support of that claim. But of course, there are a number of different risks in addition to all the typical publicly traded or traditional investment risks. The risks in alternatives include things like they're not subject to public disclosure. There's a higher risk of loss to all or part of principal. And of course, there's a liquidity risk. It's usually limited or sometimes no liquidity actually to maturity. And so overall, typically we would recommend alternatives as a small part of the portfolio. Although if you're talking about, let's say, endowment funds over the last few decades, their share of alternatives in their portfolio has grown tremendously. But then again, endowment funds are the perfect customer for it. They technically live in perpetuity. They don't have estate issues. They don't need liquidity for a long period of time. So that's a slightly different case. For most individuals, what's on this slide holds true. So what's an accredited investor? The simplest definition is that an investor has to pass one of two tests. Either 2 years of annual income over $200,000 or $300,000 with partner. And the reason it says 2+ is because there's a reasonable expectation that in the current year, the investor would have the same income, or at least income that qualifies also as the previous 2 years. Or the other test is a net worth of over $1 million, and that does not include primary residence. There are several other tests, including, you can see here, leadership of a company where they may be dealing with pre-IPO shares, or a registered representative who passed a specific NASDAQ test, such as Series 65. But generally speaking, for investors, it's one of the first two boxes. It's interesting to note also that this has been legislated a while back, and these numbers are constant. In other words, they're not inflation adjusted. So there is a reasonable expectation that people who are accredited today, the number of those is much higher than it was, let's say, 10 years ago. And as far as I know, these numbers are staying the same for now. And so what are the actual alternatives? This is the alternatives universe. I'm not going to spend too much time on this, but this is an attempt to actually include all the different asset classes that exist in alternatives, and it definitely does not capture all of them, but hopefully will give you a pretty good indication of what we're looking at. So anything growth related would be on this clock from basically 12 to 3. And then the majority of it is income, and then there's some tax advantage, and of course they overlap a little bit. And so what we're looking for on the right side, the first from 12 to 2 o'clock, essentially, is venture capital and private equity. And then right after that is alternative assets. And these are the major things that we will be talking about today. Although real estate is obviously dominating the left side of it, and private credit, or essentially anything, any income strategies, they may come up as well. So, and these are the returns. This is actually a JP Morgan report that came out, I believe, last month, that shows you over the last 10 years what the alternatives have done. So the size of the bubble here shows the yield, and then it shows the x-axis is the trailing correlation to a 60-40 portfolio, and the y-axis is the 10-year annualized return. And so you can see venture capital and private equity, while the yield is very small, obviously, they're small bubbles, but they're right up there in terms of annualized return. So keep that in mind as well. Well, you probably knew that was coming. So more definitions. What do we need to define? Venture capital. So that is that type of financing that startup companies and small businesses get with long-term growth potential. So what's important to know about this is institutional investment. Venture capital is institutional investment. Private equity, this is something that a lot of investors and actually some financial professionals may be confusing venture capital, and that's probably because one way the term private equity is being used is to include everything that's on this slide, and basically anything, any investment in companies that is not a publicly traded stock, which is not necessarily the best definition. The traditional definition of private equity as an asset class is a partnership to buy and manage a company and then sell it. So the business model for private equity is different than venture capital in two major ways. One, you're probably not buying a company for growth. You're buying a mature company where you think the valuation is low. You bring in your own operations people, you revamp it, you fix whatever problems you think are there, and then you try to sell it back to the public at a profit. That's the business model. And you would typically buy the entire company. You would not just invest in it. And for the investors to get involved in that, you would probably buy into an investment fund that private equity would sell you as a way for them to fund their purchases. Some of the private equity companies are actually publicly traded, which is a little counterintuitive, but you can invest in their equity, which is a private equity company. So companies like Blackstone, for example, or Carlyle, you can definitely invest in those stocks. And then the final definition is angel investing. And, that's the term that's very similar to venture capital. The major difference here is that we're talking about an individual investor as opposed to an institutional one. All right, so now we're ready to talk about crowdfunding. So crowdfunding is nothing more than just a financing method in which money is raised. And the idea is that you approach a relatively large group of investors, but for relatively small individual investments, and that's basically the definition. This was introduced originally in 2015 as part of the Jobs Act. And it has a number of key requirements that you need to know about. First of all, companies can only raise up to $5 million using crowdfunding in a 12-month period, which for a lot of younger companies is not an issue. Investors. So if you are an accredited investor, there is no limit. But this is specifically designed for people who are not accredited investors. And for those, there are a couple of limitations. So you can invest up to $2,200 or 5% of annual income or 5% of net worth. Whichever of these three numbers is greater, this is the limit that you can invest in crowdfunding in a 12-month period. And this is done specifically for protection of individual investors. The companies are required to provide financial statements, and they have to be certified by an independent public accountant for any offering that's over $100,000. So again, for protection of investors, financial statements have to be certified. The companies also must disclose how the funds will be used, and they actually have to also provide updates on the progress. So after a company has done crowdfunding, up until they're public or they're bought out or they go out of business, they have to provide regular updates, effectively quarterly statements. Companies don't need to register with the SEC. And as you can see from my wonderful green and red color coding, you know that's a good thing for the company because that's usually a major pain. However, they still must register the offering, the so-called Form C, and they also must file annual reports with the SEC. And those updates are provided to investors. And also offering under crowdfunding is for US companies only, and the stipulation is that it must be conducted on an internet platform through a registered intermediary. That's important. This is why we're dealing with some of these registered intermediary that actually help, but they do have fees typically. So this is the summary of major types of registrations. There is a link here to the SEC website that actually lists another 7 or 8 that are very obscure. You can feel free to go there. But basically, a very high level. So Reg 506B and 506C are the major types that you would see alternative funds being issued at, and hedge funds for that matter. The main difference is that 506B allows up to 35 investors that are not accredited, but generally this is for sophisticated investors. And neither one of those can be generally solicited. You have to approach only investors that you believe qualify. There's a Reg A and a Reg A Plus. The difference is the size and some onus on disclosures. But again, this is a slightly cheaper way for companies to raise money than 506B or C. You can raise up to $75 million, but you still need, as you can see in the SEC filing, quite a few things that you need to file. Then there's Reg D, which is up to $10 million. It requires a Form D, which is more complicated than Form C for companies to file. And then there's Reg CF. That's the crowdfunding. That's the one we're talking about. And we already covered the major features of it. But this is the main vehicle that allows non-accredited investors to invest in something that's alternative. So what are some of the advantages of crowdfunding generally? As you can see on the right, these are some of the platforms, some of the better known platforms that I've talked about, but most certainly not all of them. So for the companies, there is a low cost to run the campaign, and there is a low compliance burden. It's also an ability to reach big masses. So for solicitation, companies looking for crowdfunding can easily advertise their fundraising as opposed to anything that's done for accredited investors only. It's also an ability to offer fractional shares of assets. So this is not just equity we're talking about, and I'll give you a number of examples that not equity that were not possible before crowdfunding. And then finally, the access to these investments have been democratized. At the end of the day, if you're looking to raise $10 million, it doesn't really matter whether it's 10 people who are investing $1 million each, or you have 10,000 people investing $100 each. The result is going to be the same. 10,000 people investing $1,000 each. So the registered platform that's required, there's currently over 70 of these platforms. They're all registered with FINRA, and they have to abide by a number of rules, but they also are very helpful to investors and advisors. And I'll talk about that in a second. So equity crowdfunding platforms, the two main ones, the two leaders are vFunder and StartEngine. For the sake of full transparency, I've used both of those and extensively, and I'm also an investor individually in vFunder. These are the two main features. The first two columns show the main features of these two platforms. So vFunder currently has over 1 million investors since they started. They are probably the largest in terms of number of deals, as well as number of deals listed and done in the past, and the total raised and the total founders founded. However, they tend to have a slightly smaller average size deal than, let's say, StartEngine. vFunder is also registered in Europe. They charge typically 2% fees from the investors on every investment. They also run a VIP membership program, which gives you 10% bonus of shares, and that has an annual subscription of $275. So essentially, if you're looking to spend, let's say, or invest $3,000 a year or more, this membership makes sense for you. They also have early bird bonuses. So what that does is when new deal shows up on a platform, typically you have a limited window, like a week or 2 weeks, to invest and get additional shares. They also provide perks from the companies, which is interesting. Usually, those perks include the products and the services that the company provide to begin with, either for free or at significant discounts. So they may be useful, but there are some additional perks as well. And also one unique thing about it is that they offer a portfolio of Y Combinator graduates. So every time there's a new session of those graduates, you have an option to invest. I think the minimum is something like $5,000, and you can buy an entire portfolio of 20 or so that have just graduated. StartEngine, you've probably seen the commercials. Kevin O'Leary of the Shark Tank fame is a spokesman. They recently acquired Seed Invest, which was also an equity crowdfunding platform. Their fees are higher. It's at 3.5%. Their membership is also slightly higher. They also offer early bird bonuses. And then this is where they are different. They actually have a private section, which is they offer late stage accredited offerings. They also help verify investor qualifications for where accreditation is needed. So that removes onus on both the companies that are raising funds and on potentially advisors. And then finally, they have their own marketplace that provides some limited liquidity. Of course, if you actually need to sell some shares, you're probably not going to get the best price for it, but at least there's some liquidity. And then the right column has a list of a number of different other platforms that are also using equity crowdfunding. Republic is probably the largest one of the rest, but all these other ones are also there. Crowdcube is the largest in Europe. And then the bottom four actually are niche players that specialize in specific space. And one of them actually does specialize in the space. MAC 33. So moving on, the other alternatives in crowdfunding, and believe me, there are quite a few. I just want to make sure that you're aware of this because I'm not going to talk too much about them. But they require different types of due diligence. They're all different animals, but they all exist there. So real estate is probably the largest of them all, as big or maybe even bigger than the equity space. The ones that are highlighted, by the way, just again for full transparency, are the companies I personally invested in, and I've invested on the platforms of Arrived and Nada. So Arrived is a single family rentals, which is an interesting concept that was essentially born after the financial crisis of 2008, when some individuals and mostly hedge funds started buying up single family homes with the whole idea of just renting them out. And now a lot of other investors got into this business, and Arrived is the biggest of the crowdfunding, where effectively they have a team of professionals who buy up single family homes and rent them out, and you have a chance of buying into any individual home or in a fund of those homes to collect rent in a passive way. And Arrived specifically is also boasts Jeff Bezos' own personal venture capital fund as one of the investors. Nada is very different. Nada actually invests in home equity in houses in metro areas. So instead of offering a high yield, they're looking for growth. They offer homeowners home equity at a discount valuation to their house, and when the house is eventually sold, investors can get appreciation. But there are all these different other types of real estate companies. A lot of them are dealing with commercial real estate of all kinds, so multifamily, industrial, even medical properties, some offices if you dare. And there is also a group of companies that are doing farmland specifically. And then, of course, there is even one for 1031 crowdfunding. So for 1031 plan, you can also do, instead of getting on one of the specific 1031 platforms, you can also do a crowdfunding through this platform. And then in the second column, you have all kinds of collectibles. Art is, you've probably heard of Masterworks. Then there's wine, there's whiskey, precious metals. Again, the whole idea of all of these is that obviously there are funds out there, alternative funds that manage these assets already. There are wine funds, there are art funds, obviously any kind of precious metal funds. What you actually get here is that you get fractional ownership of these assets. You don't actually hold a bottle of whiskey or a specific collectible or a specific piece of art. You buy essentially a fractional share of the securitized collectible. Same deal with income. So there are several that invest in music royalties, for example. There are P2P loans, so person-to-person loans. As far as I'm concerned, these are probably the riskiest of all of them. My racehorse. Yes, believe it or not, you can actually buy a share of a racehorse. Then there's litigation finance, and then there's even a relatively new idea of a future athlete income or even a future celebrity income. It's similar to music royalties, but the idea is when if it's let's say an athlete in early stage, they sign off a portion of their future income with some stipulations for an immediate cash injection to get their careers going. So exactly how this is going to work, nobody really knows. This is a new area. Every contract is different, but there are already platforms that do this, and this is fintech at its best. So just be aware of all of those things that exist. On the right side, you have products. So this is also part of what crowdfunding legislation gave us, uh, the likes of Kickstarter and Indiegogo. But here you only invest into a product at a discount that you're hoping is going to be built. You're not actually investing in companies. On the other hand, the list below, cross platforms, these are different platforms that allow multiple of these different types of alternative investments to be invested all in one platform. Fundrise, I believe, is backed by Goldman. Yield Street is, I believe, is the biggest one. So be aware of all of these. And I know I'm taking a lot of time, so I am going to try to speed this up a little bit. On fundraising stages. So what you need to know is that there are typically 3 stages you're looking at. The seed stage is the very early. This is basically the team is formed, some basic market research is done, and maybe they start working on the prototype. This is really early, and obviously the earlier you are, the more the upside, but also the risk. And then you have early stage, Series A. Series A typically refers to a fundraising with venture capital, where you start looking at growth. And then Series B or C, they don't necessarily have to happen. Or in some cases, they go much further depending on the company. I've seen companies that go public after Series A, and I've seen companies that go as far as Series F. But typically, we're talking about late stage where they're looking for the so-called exit. In other words, usually an IPO, or in some cases, being acquired by a larger company. And below, you can see, as of last year, the average size of financing for these rounds. So what should be your expectation for early stages? The fact is, over 60% of startups fail within the first 2 years. And this is something to keep in mind, because this may come as a shock if you're new to it. So what you need to do is aim for 10 times potential returns, because that will cover 9 losers. So you want to diversify, you want smaller investments across multiple companies. This is probably even more important than in your public allocations. And this is what your hypothetical portfolio result would look like. Again, hypothetical. If you invested in 10 companies, 6 fail, 1 doubled, 1 tripled, 1 went up 5 times, and 1 went up 10 times. Overall, you're looking at roughly, well, it looks like double the capital that you invested in for the 5 years. Again, this is a hypothetical illustration, but I think it's pretty typical. So, getting started, we're finally there. So how do we get started? You can sign up on a platform of your choice, and that's free. And then you get an email with deals, or you can just go and browse. What are the first 3 steps you're looking at? First step is read the description. It's usually the first paragraph. What's the story? What is the problem that is being solved? And as any VC will tell you, the bigger the problem, the bigger the upside. I can tell you that from my experience, in about 95% of cases, this is the end of my research. and that's a no. There are a number of different reasons why. Usually the story is not interesting to me, or it's not my area of expertise, or it doesn't fit my criteria for looking for a company. If you watch the Shark Tank, you probably hear the excuses. It's too early for me. It's a product, not a company yet, or whatever the reason may be. A lot of the times you kind of know right away. But if you pass this step, estimate TAM. TAM stands for the total addressable market, and obviously that's easier said than done. If we're talking about things like artificial intelligence, some of the numbers that are being put on that are as much as 75% of the global economy, which I think is probably reaching. But what you're worried about here is not necessarily the top. You're looking at the bottom. So if we're talking about a local restaurant, even if it's the largest, the most prestigious steakhouse in New York, you're probably looking at 10 million revenue a year. You're looking at an average restaurant, less cost of living, high cost of living area. You're probably looking at 1% of that. So you kind of know what the ceiling is, and that's what that is. And then, of course, did I mention that I also like quotes? To me, quotes are like this little pearls of wisdom that you can apply different situations. And when it comes to investing, you want the wisest guy who's been in that. And Warren Buffett, as far as I'm concerned, is the most quotable. And this particular quote is very applicable to especially startup investing, because what you're looking for in the story is innovation. You're looking for something new. You don't want an imitator. You don't want a Me Too product. So when you look at competition and you look at potential moat, whether it's a different way that the company is doing it, whether it's patents, whether it's regulation, you hoping to find something right away. And usually companies will disclose that upfront, but sometimes you need to do a little more research. As a quick example, I ran into a company recently that was claiming to produce water out of air using essentially a condenser type technology. Had a very impressive presentation and presented themselves as a game changer, but had no revenue and a few patents pending, but they look like, an air conditioner, a condenser essentially. So after quick research, I found out that there's at least 40 companies that I was able to find in the first 5 minutes that are already doing that. A lot of them are a lot more advanced, and they're doing it in places like Sahara Desert. So a lot more impressive, a lot more advanced, and I don't think that this company can compete against them. They don't have the moat, and they're definitely the imitators. And the last thing you definitely want is the idiots. So try to go for the first movers if you can. So when it comes to due diligence, there are three parts of it. There's the business, there's the valuation, and then there's the legal. And the reason they're uneven is because the legal is the smallest portion, and that's thanks to the crowdfunding framework. Typically, there's a lot less to review, but I'll cover that anyway. And what I do is I use something I call a soccer rule. Essentially, in soccer, if you commit a flagrant foul, you get a red card and the player gets sent off. If it's a dangerous foul, you get a yellow card, but if you get two of them, it's an equivalent to a red card. So what I'm looking for is a yellow flag, which is a significant concern, whether it's something with the team or there's a revenue dip or there may be a number of different things that could be a yellow flag. But a red flag is an issue that can kill the company. This is usually a legal issue. So a good example is something like Napster. You look at their business model and you probably knew that this is not going to last. And of course, my point is two yellow flags to me is the same as a red flag. It's much easier to walk away than to lock up your money for a few years only to find out that you're going to lose it all because of these flags. So this is my due diligence approach. There are many different ones, but I use a scoring system. Did I mention I like numbers? Right. So 11 categories. I score them from 1 to 10. Here's an example. My impact category, from top to bottom, this is from 1 to 10. And this may sound a little corny, but once you do your due diligence and read through and look at the presentation, you can probably, after a few tries, get a pretty good idea where that fits. And I look for the score of 70. So the maximum is 110. I've never had a company over 90. But again, this is very subjective and you can use it any way you want. And these are the scoring categories that I use. Start with the idea, look at the impact, look at the moonshot potential, and then mode that we just talked about, competition in general. Go-to-market strategy is actually extremely important. Then you look at the team, the current investors. This is not everything, but it does help if you have some notable investors, whether it's funds or wealthy individuals in it. Financials, valuation that we'll talk about in a second, and various risks. So how do you look at business due diligence? You look at risks. So you know that a lot of these companies will fail. So ideally, you want to look at risks and try to minimize them. And this is a list of top 20. It varies year to year slightly. It varies also by different platforms that conduct this research. The Crunchbase is the one I probably trust the most, and this is a fairly recent one. So what you can see here is that shockingly, number one is no market need. A company fails to do their market research, they do a product, they launch it, and find out that nobody wants it. So one good way to mitigate against that, get their product or service, try it out. If this is a consumer product, that's probably the easiest. Of course, sometimes it may not be available for a long time, but that's a different challenge. Running out of cash is the second one, and this happens a lot more than you would think. So there's companies like Olive AI. It's a healthcare startup that has gathered $852 million. Convoy, it's a freight startup that raised $900 million. Vive, a home construction startup that raised $647 million. They all went bankrupt in Q4 of 2023 because they ran out of cash. So financials is the way to, but that's what you want to look at. And obviously there are so many smaller ones that ran out of cash. Not the right team. Just a quick example I would give you. If you remember the company called Groupon, they're still around. Shortly after the IPO, they were worth $10 billion. Their founder, Andrew Mason, he was also the first CEO. He was a music major. He almost founded it by accident. No tech, business, marketing experience or consumer products experience before. And that caused a lot of tensions. And eventually he was fired. But the company, the whole culture, the whole direction was in flux with him there. And since, and after the original hype went away, the company is surviving, but just barely. So there are many other examples. So look at the team, make sure that there's a good fit there. And I'm not going to go through the rest of them, but you get the idea. There's quite a few of them. And the legal challenges is, again, one of those things that to keep an eye on as one of the largest risks. Timing, just wanted to mention that. So many teams miss time their launches. In the second week of March in 2020, I walked outside and I saw a grand opening of a Thai restaurant in Manhattan. This was literally 3 days before the entire country shut down for COVID. And I thought to myself, this was probably the worst timed business launch. So again, keep that in mind. Timing could be very important, especially if it's tied to a specific event, or tied with a some sort of partner in mind. There's a lot of different things that go into timing. All right, due diligence on the legal side. What you need to know is the type of investment contract that you're dealing with. So SAFE is the most common one. This is the future equity. This is essentially private shares in the company. There are convertible notes that are also out there. There's loans that convert at a future date. You need to know the conditions of when they convert and at what price and under what conditions. And then there are some others. Again, just keep in mind that those are there, especially on the platforms you will be dealing with. But you do need to make sure that you know what that is, because if you end up investing into a loan instead of a equity, you're probably going to have an issue. Dilution. That means your share of the company gets lower with next rounds. That's not an if, that's a when. Everybody gets diluted. You just need to know what the rules are around it. Even public equities sometimes issue additional shares and dilute it. So it's not a problem as long as the company is growing and your stake grows. Voting rights. You probably won't have any, but in case of angel investing, when you can negotiate your own rights, you may want to think about that portion. Risk and other SEC disclosures. So companies that go through crowdfunding, they do definitely have to do some disclosures. So look through those. And any special provisions, things like exit definitions, whether they define certain things as exit or not, whether there are any provisions on later rounds, and also if it comes to any kind of legal arbitration, what are your rights? Again, most of those things are going to be standard in the contract on the BeFounder or Start Engine platforms, but know what they are. Valuation. Okay, so to be sure, this is there are hundreds of books written on this. There's tens of thousands of hours of videos and webinars and presentations and even business school classes that are being taught on this by people who are a lot more experienced and eloquent than I am. So I'm going to spend about 2 minutes on this, and I'm going to give you the very high-level approach. And the point is, it's more art than science. A great company does not mean a great investment. If you've gone to this point and you've decided you'd like to invest in the company, it might be a great investment if it's valued at 10 million. It might be an absolutely horrific investment if it's valued at 100. So how do you approach this? There's a link here to approaches, top 10 approaches. And again, even that is very, very summarized, but it will give you some ideas. Some of the issues you have compared to public investments is that your information is limited. Financials are going to be outdated. Even if the company publishes 2 years of financial statements, let's say you're looking at them right now, these are going to be financial statements for the years 21 and 22, which are hopelessly outdated if you're trying to make a decision today. Projections are going to be meaningless. One of the companies I was talking to and asked them about their valuation, they said, well, by 2030, we're going to be making 50 billion a year, so you're buying at a huge discount. Yeah, based on what? So obviously, projections can be really verified. And of course, there's no professional analyst to cover these companies, and traditional valuations such as P or PS ratios are typically unavailable because you don't have earnings. And in those few cases that you have sales, they're probably so far in the past that they're not meaningful either. So what you can do is you use comparables. So you use companies in the same industry, because that's very important, because they have different capital requirements and they have different runways. You consider future revenue commitments. So in many cases, the company may not have a revenue, but they may have letters of intent from companies, especially if you're talking about industrials or energy companies or technology hardware companies, or biotech companies. You have a lot longer for them to develop a product that can give them revenue. So what's important is to have those letters of commitments or of interest from different companies, because that will be their future revenue. And then, of course, you look at their growth and market share, and realize this is more important than profits, especially at early stages. And then ask the company, like I said, ask the company how the value was arrived at, and you'd be surprised. If they have a method, at least it could make sense. If you get an answer like the one I just got, that's a yellow flag right there. All right, these are some of your sources of information. So when you're doing your due diligence, that's the left side. All of these things are important. Look at them. Reach out to investor relations. Look at company updates on the platform, like the founder. Also sign up for their email list, and they will send them to you. And then after the trade is made, you're still there. You're now a part owner. So get the updates again from the platform and the company. Look at the filings. Talk to their investor relations. If you have a sizable investment, chances are the company will reach out to you. They want to thank you. They also want to see if you want to partner with them in any way. If you bring an expertise, you may actually be good as an advisor on their board, which could be both beneficial to you and the company. It could bring some extra income, some extra visibility. It could actually be fun, and you could be helping the company while they're paying you. There is also a potential of any kind of introduction, whether it's capital introduction or expertise introduction. You're now a part owner, so you can do small things to help the company, and the company will be appreciative of that. And then also look for later rounds. So again, if the company is successful, they will, and you got in early, you probably want to participate in next rounds and in the next rounds until the IPO. In fact, the second investment is usually the most profitable one, just because the company made it this far, and at this point, you probably have VCs coming in, and with major funding, and if you invest alongside them, that's going to be your most profitable round. All right, it's 3 minutes to the hour. We're going to run over a little bit. Hopefully you guys can stay a little longer, but we're finally getting to impact investing and where the intersection is. So these are 3 different definitions, but they're all very, very similar. And essentially, if you're familiar with impact investing, hopefully you know what I'm talking about. It's an investment. So you're looking for a financial return, but this is alongside something that could be called a benefit or positive impact. What that is very subjective, obviously, but can be also defined in different ways for different investors. And there are all these different asset classes that are present in impact investing, and what we're talking about right now is actually more on the bottom part of it than anything else. So why crowdfunding is a good place for impact investing? There are several reasons. One, there are a number of startups that specifically focus on impact. In fact, impact is part of the business model. The reason the companies start up, they look for a problem to solve, and that problem itself is based on impact investing. So my sort of working definition of that, positive impact, is something that improves people's lives, whether it makes it something easier to access, easier to use, cheaper, more affordable, if it improves lifestyles, if it improves conditions, working conditions, improves communities, improves environment, health, education, all of those things. That's a positive impact. And so there are a number of themes. I'm just listing several here. Almost anything in those themes would be a positive impact as far as I'm concerned. But there's obviously a lot more. And within crowdfunding, you find startups that what I call are pure plays, meaning they line up exactly with somebody's value. If somebody is looking to invest specifically in education or environment or healthcare, a lot of the times public investments are not pure play. There may be companies, there are conglomerates that do a number of different things, and also something that you're looking for. And it's probably a smaller part, and you're not going to invest in that company just for that. But within startups, they are pure plays. They may be doing exactly what the investor is looking to do, looking to invest in. All right, and I'm going to run through 4 use cases. So these are my actual investments, again, for full transparency. These are investments I've made over the last couple of years. I am not here to promote the companies. Those rounds, I believe, are all closed, so you can invest in them, at least not in this round. And the reason I'm doing this, I'm not promoting the companies. I am just trying to put together everything I talked to up until this point to give you some ideas of what's out there and how you can use some of the methods that I talked about and some of the ideas that I've shared in the actual investments. So the first one is Active Defender. This is a company that actually designed an app that allows people who work at school to act in case of emergencies, primarily in terms of active shooter situation, but also other emergencies like earthquakes. And we've had one in New York area just a couple of weeks ago, which is crazy. And things like fires and others. So the innovation is definitely there. It's a very new approach. They have a couple of patents pending with high impact. What they do is it's a team that includes educators, law enforcement, Army veterans, and technology people, which is a great mix. And what they do is they offer subscriptions for these. They also do training for this app for each individual school. But what they do is they target school districts, and they pitch it to school districts. And when school district subscribes, they make every school in the district at every level to get that and to get training on it. So far they already have 154 school districts, mostly in Midwest, across something like 21 states, I believe. So they already have a huge penetration, and they're growing fast. So their last year revenue grew 330%. They expect something like 1,000% growth this year, and they were only valued at $12 million. So clearly that checks all my boxes. The next one is Hold On Bags. So this is a company that creates household goods, mostly things like Ziploc bags or garbage bags that are compostable and they're plant-based. I actually couldn't believe it until I got some of the samples of this from this company. Their bags look just as good as the plastic bags I get. They actually feel better. But the whole idea is that these bags decompose on their own in soil in less than 2 months. Their closest competition has compostable bags that's decomposing in 5 years, which is obviously night and day. Clearly high impact as well. Great team with the area of expertise, and their go-to-market strategy was get on Amazon and get on Whole Foods, because Amazon is where you want for any consumer product. And if it's a home consumer product, you want it in Whole Foods, especially if it's impact. And they're already there on the shelves. They're selling. They got $3 million of revenue in just 1 year in business, and they were only valued at $15 million. All right, two more, and we're getting close to the end. So this one is a little harder to explain because you need to know the science behind it. Aquagua, they are working to end the so-called forever chemicals in water. So they're called forever chemicals because they're very difficult to dissolve. And in most cases, they're not super harmful. They probably exist today, many water supplies, but there's a new EPA requirement to get rid of them. It's also considered a national security issue. And you basically need a solution that involves technology, chemicals, and industrial companies together to get this done. This is the company that's at the forefront of it. They're one of only three companies that the government, the EPA agency, has designated, and they're working with one of the major industrial company that's going to be their client, which they can't even disclose yet. I actually met with the founder recently. I had a really interesting conversation with him, one of the founders. So again, they have been awarded a number of things in contracts already, as well as government grants. And the company was only valued at $10 million at the time of my investment. And then finally, Matco 3D. They are a construction company that's using 3D printing. There's a number of those, by the way, these days, because 3D printing has finally been shown to do great results in construction, saves a lot of time and money. But what's different about this company is that they use that coral. So this is their main ingredient of building. Turns out they've done a lot of studies that have been confirmed that that coral is a great building material, and it's flexible, yet it's also sustainable. They have 5 patents for 3D printers that specifically use that coral. But in addition to this 3D printing impact, which allows them to build a very affordable housing, they also do another impact. They collect that coral, because when coral dies, the entire environment around it dies, and unless it's removed, a part of the ocean will be dead for for the foreseeable future. So what this company has done is they've already made several um, contracts with coastal states and some of the Caribbean nations to remove their that coral, which is already a revenue coming in. And on top of that, they have letters of interest from a number of communities, mostly in southern states, but some in the Midwest as well, for their housing. And they were only valued at $30 million with the patents and with technology, with those 3D printers already available, and some of these contracts already available. So again, on the valuation side, pretty good deal. All right, so one more thing I wanted to mention. There's 3 different things that were made possible by crowdfunding. We've been asked before, what are some of the new things that crowdfunding brought. These are top 3 areas that literally were not available before. Most food and alcohol businesses are private, and even those that go public, like Heinz, they're still to this day controlled by by the family that founded them. And something like Mars is still a private company and have no intention of being public. But nowadays, you can invest in things like organic farms, creameries. Obviously, wineries and distilleries have probably not the impact per se, but there are a number of organic places that could be impacted. The other one is sports teams. Also a very different animal. You need a different type of due diligence for that. Mostly there are soccer teams, but also there's new women's teams that are becoming professional. And if you understand the roadmap to how these companies can make profit, they can be very interesting investments. And then the third one is independent movies. Those, again, were typically not available to regular investors, and now they are, and there's plenty of them. So for independents to make a movie, you need to raise funds as opposed to a studio that budgets for it. And what you can see down here is a picture of me. I'm all the way to the right at the premiere of an independent movie called My Dead Friend Zoe at South by Southwest, which was last month in Austin, Texas, which was one of my investments. In fact, I'm an executive producer of that movie, and apart from um, shameless self-promotion, the point is that it's now available to investors, and this particular movie is about veterans, what they go through, and their daily lives after they serve. It's a fiction. It's a feature movie. It's very well made, but it's also definitely an impact type investment as far as I'm concerned. So keep those in mind as well. Um, so getting to working with clients, these are the three common situations that you would probably come across as an advisor. That what we see. Somebody who asked to be an angel. You know, my cousin, uncle, college roommate, friend of a friend is starting a business and is asking me to invest $10,000 for 10%. Should I do it? So in this type of situation, typically there's not a lot of due diligence to be done. You don't really know much about the business. It's probably early stage. You want to make sure that the legal documents are there in terms of you know what the role of your partners of your client is going to be in this partnership. But generally speaking, this falls under financial planning more so than anything else. You basically would look at how important this is to your client, and can they take the hit if they lock up this money for a while or lose it all eventually. So this is more of a financial planning situation. Considering crowdfunding investments. So somebody who comes to you and says, I'm looking at company X, I'm looking to invest $1,000. Can you recommend it? Typically a due diligence for something like that is way too expensive. Unless you've already done the due diligence for this company, it just happens that way, that's great. But normally um, you have to treat it as a separate project, and it's probably cost prohibitive. But the third situation is when you're dealing with typically a high net worth individual who says, I'd rather not invest into venture capital, but I hear that this is a good place to be in. Can you find me a portfolio of early investments? And ideally, this is what my impacts I'm looking for, environment and healthcare. Um, and this is something that we actually can provide, since I personally have invested in more than 70 companies and in 10 plus venture funds. I have enough experience and I look through them regularly. So if something comes across and I'm already doing due diligence on that, I might as well help a client who's looking to do number 3 here on this list. My general approach is it's okay to say no. This is what I do with cryptos, for example. So I don't know how to value them, and therefore it's your money. You can use it if you on crypto or digital assets if you'd like, but I can help you. And it's okay in case number 2, for example, as well. You obviously have to determine suitability for a client to invest into something like this. And what we've been recommended and we've developed is a document that's an addendum to investment agreement that outlines the risks and expectations. This is both for the client and for the advisor. A client to actually read and understand, again, not just hear it from you, the advisor, what the actual risks are, including liquidity and including higher chance of losing the principal. Because what you don't want is an investor signing something and then 2 years later saying, wait a second, more than half of the companies you invested in went bankrupt. I want to sue. You definitely want to protect yourself against that, because I've explained it to you and you've signed it here. Make sure that the expectations are on paper, and that's that's a better way to go. All right, and so these are the three different sort of ways of doing this. Do it yourself for the investor, lowest cost and full control, but obviously requires expertise, time, and effort. Most people don't have that. And no disrespect to anybody who may be listening who is thinking, well, you can just invest $100 into 20 different companies and see what sticks. This is why financial media is calling this dumb money, because a lot of people do that with public investments as well, and usually that spells a disaster. You want at least some semblance of your due diligence to know what you're investing in and to try to eliminate some of the obvious risks. So you can do venture capital fund, which is run by professionals, but it has high fees, and those will definitely require accreditation. And then a third option that I haven't talked about before is angel investing club. So companies like, for example, 1000 Angels. I personally haven't used them, but I've interacted with them. Um, Harvard Business School alumni organization has an angel club. There are a number of others. The idea is that you pay a subscription fee, and you're part of a larger group of people like you interested in angel investing. The management of the club will source the deals, will bring the deals to you, will help do a due diligence as a group thing. But every individual investor will make a decision for themselves whether to invest or not and how much. So the problem with that is groupthink goes into both categories, pros and cons. You always want to do some of your own due diligence. And of course, you have to pay a subscription fee, and there are some minimums to investments, and all of this definitely requires accreditation. And so I think I'm going to skip this, considering you already, most of the people here know who I am and who Eureka Wealth Solutions is, but this is who we are. And this is something that we do, and these are the plans that we offer, and the fees are tiered. And crowdfunding is fully included if you are at Power Plan, and that comes with angel investing as well. Basically, the reason for that is Power Plan includes our financial planning, and typically we want to do financial planning before we determine suitability or recommend any kind of investments in alternatives, and especially in crowdfunding. But obviously, advisors can decide for themselves what works for them. All right, and we finally coming to an end of this presentation. Any questions at this point would be appreciated. Just a few words about me, and obviously know what Advisors for Good are. And if you have more questions, this is you can definitely send it to this email address, inquiry.zuckerman@eurekawealthsolutions.com. So any other questions at this point? All right. Well, I appreciate everybody for coming. Thank you very much. And if I will send around a link to everybody who attended or registered and was not able to make it, so you can view the video. Thank you and have a good day.